Here's something that should stop you cold. The bank where you've kept your savings for decades is right now, quietly, and without any announcement, handing over financial decisions to artificial intelligence, and most people have absolutely no idea it's happening. If you're someone who worked hard for every dollar you've saved, who trusts that your money is being watched over by real human beings, this video is going to open your eyes in ways you never expected. So stay with me, because what I'm about to share affects every single one of us, and it's happening faster than anyone is talking about. If you find this important, please hit that like button, subscribe so you never miss updates like this, and drop a comment below telling me what you think about AI running our banks. Now, let's take a step back together and think about what banks have always meant to us. For most of us who grew up in the 50s, 60s, or 70s, a bank was a place with marble floors, polished wood counters, and a familiar face behind the glass. You knew your banker. Maybe he called you by your first name. Maybe she remembered your kids' birthdays. There was a human being, a real, breathing, accountable person, standing between your hard-earned savings and the unpredictable world of finance. That relationship felt safe. It felt personal. It felt trustworthy. That world is changing. And not slowly. What's happening right now inside the largest financial institutions on the planet is a transformation so sweeping, so quietly dramatic, that financial historians may one day look back at 2025 and 2026 the way we look back at the invention of the printing press or the arrival of the internet. And just like those revolutions, most ordinary people didn't see it coming until it had already changed everything. Let's start with something called agentic AI, because this is the centerpiece of the whole story, and once you understand what it is, everything else will make perfect sense. You've probably heard of AI assistants, things like chatbots that answer simple questions on a bank's website, or automated phone systems that direct your calls. That kind of AI is essentially a very sophisticated answering machine. It responds. It suggests. But it doesn't decide. Agentic AI is something fundamentally different. It doesn't just answer questions, it takes action. It executes. It makes decisions and follows them through from beginning to end, all on its own, without a human approving each step. Think of it this way. If the old AI was like a very helpful receptionist, agentic AI is like a full employee who has been handed the keys to the office and told, handle it. And right now, Goldman Sachs, one of the most powerful financial institutions in the world, is actively developing these autonomous agents to handle things like trade accounting and bringing new clients on board. Lloyds Banking Group in the United Kingdom has already announced what they're calling an enterprise-wide deployment of agentic AI throughout 2026. What does that mean in plain language? It means that when a fraud investigation gets opened on your account, or when a complex complaint gets filed, there's a real chance that the entity reviewing it, processing it, and deciding what happens next will not be a human being. It will be a program. Now, before you panic, let me be fair here. The banks will tell you, and they're not entirely wrong, that these systems are faster, more consistent, and in many ways less prone to certain kinds of human error. The productivity gains expected from this shift are estimated between 22 and 30%. That's not a small number. In a large bank, that kind of efficiency could mean faster service, fewer errors in routine processing, and lower operating costs. On paper, those sound like good things. But here's where it gets complicated, and where you, as someone with real money in real accounts, should be paying very close attention. These AI systems operate in ways that even the engineers who build them sometimes struggle to fully explain. When a human banker makes a decision, you can ask them why. You can sit across the desk, look them in the eye, and say, "Why did you flag my account? Why was my loan denied? Why did this transaction get blocked?" And they have to answer you. Regulators are only just beginning to wrestle with what happens when the decision maker is an algorithm, and nobody can fully explain the reasoning behind what it did. There's also the question of something called algorithmic bias. AI systems learn from historical data, and if that data contains patterns of discrimination or unfairness, even unintentional ones, the AI will quietly replicate and even amplify those patterns. The very people who may be most affected by this are often those who have been navigating the financial system longest, people who may have faced barriers in the past and who deserve nothing less than a completely fair evaluation of their financial lives today. Now, while all of this is unfolding with AI, something else equally significant is happening in a part of the banking world that most news outlets barely cover. Major banks are quietly transitioning to something called tokenized deposits. I know that sounds like tech jargon, so let me translate it into something real. You know how your money used to be a physical thing, bills, coins, something you could hold in your hand. And then it became digital, just numbers on a screen in your online banking app. Well, tokenized deposits are the next step in that evolution. They are digital versions of your traditional bank account, but instead of living in the bank's internal computer system, they live on something called a blockchain. JP Morgan and Citibank, two of the largest banks in America, are already moving in this direction. The reason they're doing it is competitive survival. There's a new kind of digital money out there called stablecoins, issued by private technology companies, and they're attracting enormous amounts of money because they offer something traditional banks currently can't: instant transfers, available 24 hours a day, 7 days a week, 365 days a year, with the ability to be programmed to make payments automatically when certain conditions are met. Banks are terrified, and that word is not too strong, that without moving in this direction, they could lose as much as $1 trillion in deposits to these private digital currencies. Tokenized deposits are how banks intend to fight back. By building their own blockchain-based deposit system, they're trying to offer all the speed and flexibility of crypto while keeping your money inside the regulated, protected banking system you've always known. Whether that reassures you or unsettles you probably depends on how much you trust the financial institutions that, in many cases, you've been dealing with your whole adult life. And speaking of trust, let's talk about something that should matter deeply to anyone who has a local bank branch in their town, or who remembers when every community had its own neighborhood savings institution. The number of banks in the United States has absolutely plummeted. In the not-too-distant past, this country had approximately 12,000 banks. Today, that number is around 3,000. And it's still falling. Small and mid-sized banks are disappearing, absorbed by larger institutions or simply closing their doors, crushed by the rising cost of technology and the weight of regulatory requirements that bigger banks handle more easily simply because of their size. The branch closures tell the same story in a very visible way. JP Morgan has closed 66 physical branch locations since late 2025 alone. TD Bank has shuttered 51. These aren't just numbers on a spreadsheet somewhere. Each one of those closures represents a real community, often in a smaller town or a less wealthy neighborhood, that now has to drive further, wait longer, or figure out how to do everything online. For many seniors, for people with limited mobility, for anyone who still values the ability to walk in and speak to a human being about their money, this is not a minor inconvenience. It's a fundamental change in the relationship between people and their financial institutions. While all of this is reshaping the banking landscape for everyday depositors and account holders, something equally dramatic is happening on the lending side of the ledger. Traditional bank lending, the kind where you go to your local bank, sit down with a loan officer, and apply for a mortgage or a small business loan, is being steadily replaced by what's known as private credit. These are loans made not by regulated banks but by large private investment firms that operate with far less public oversight. Private credit now controls roughly 15% of the global lending market, which represents a staggering $41 trillion in total addressable loans. Regulators around the world are increasingly worried about the hidden connections between traditional banks and these private funds, particularly when banks use complex financial instruments to transfer risk off their own books and onto these less regulated entities. If something goes wrong in that shadow network, and there are serious, credible people in finance who think something eventually will, the ripple effects on ordinary savers and borrowers could be significant. There is, however, a counterweight to all of this that is worth understanding, because it represents the world trying to catch up and put guardrails on what's been described here. Governments on both sides of the Atlantic are in the process of building new regulatory frameworks specifically designed to manage this new financial world. In the United States, legislation called the Genius Act is moving toward formalizing the rules around stablecoins and digital banking. In Europe, a sweeping directive called DORA, the Digital Operational Resilience Act, is requiring financial institutions to bake compliance and security directly into their software systems rather than layering it on top after the fact. By July of 2026, federal regulators in the United States are expected to establish formal rules that will effectively merge the crypto world and the traditional banking world into a single regulated framework. What that means for you, as someone with money in a bank account, is that the line between your regular bank and the digital financial world is about to become far less clear than it has ever been. The old categories, traditional versus digital, regulated versus unregulated, physical versus virtual, are dissolving. Something new is being built, right now, whether we're paying attention or not. And that, really, is the whole point of everything shared here today. These changes are not happening somewhere distant and abstract. They're happening inside the institutions holding your retirement savings, your checking account, your pension, your children's college fund. They're being made by people and systems that are operating largely out of public view, in boardrooms and server farms and regulatory offices, while the rest of us go about our daily lives trusting that the financial world we've always known is still there, still working, still looking out for us in the ways it always has. The question isn't whether this transformation is good or bad. Like most great shifts in human history, it carries both promise and peril. The real question, the one that should matter to every thoughtful person watching this, is whether we are going to be informed participants in this new financial world, or whether we're going to let it happen to us without ever really understanding what changed and why. Because informed people ask better questions. They make better decisions. They know what to watch for and who to call and what rights they still have. And that knowledge is not just comforting, it is genuinely protective. So take a breath, because we've covered a lot of ground today, and we're just about to bring it all home in a way that I think you're really going to find grounding and practical. Stay right with me.